Okay, let's go into statement of cash flows. What we've learned in this class is called the accrual method of accounting. So the accrual method of accounting really has to do with matching revenue to its expenses, and then revenue is recognized when it's earned. Right? That's an oversimplification. It's a little more complex than that. Revenue is generally recognized when it's earned by the company, and then expenses are matched to the revenue they generate. That's the fundamental underlying theories of accrual-based accounting, which then leads sometimes to differences between cash-based accounting. We talked about some of those throughout this class. We've talked about things like inventory, where we have to match capitalize inventory, have inventory in our books, and then recognize the expense when we sell the inventory, because that's when we've earned it. We earned the revenue. We've talked about accruing for services we've provided throughout a year, right? We've talked about if I was to perform consulting services, but I got paid every 3 months for them, or once a month on the 15th, I would theoretically recognize revenue on a monthly basis for those 15 days I wasn't paid. When we would accrue for that, they would have a debit to AR, credit to revenue, right? So we have accruals for revenue, we have accruals for inventory accounts, we've talked about it for bonds. All of these differences are to follow GAAP accounting, like a rule-based, principle-based accounting system for the US, General Accepted Accounting Principles, GAAP, in order for us to have the same type of accounting as any other company, so it's comparable. So this accrual-based accounting is very useful for comparing other companies. But then we miss a key piece where we lose the concept of cash flows. So theoretically, right, I can run a business and never collect cash, or have very bad cash collection and have a very high margin, have very high profit, but then have negative cash flow. And so every company needs to have some kind of reconciliation from their income statement to a statement of cash flows, so that investors can understand from an accrual-based accounting perspective the comparability of companies, then also to present cash flows so a company can understand 3 key areas. How is the company operating from a cash perspective? How is the company operating from investments and from financing? And we're going to be going over how to perform that reconciliation, how to get back to the statement of cash flow, and then the importance of these 3 pieces, right? And so ultimately, what I'd say would make you a strong accountant eventually is if you could receive an accrual-based statement of cash, accrual-based financial statements, and be able to translate them to statements of cash flow, or to receive statements of cash-based financials and translate them to accrual-based financial statements. So understanding that back and forth is really key, right? So there's so many different types of accounting, right? We've talked about tax accounting, we've talked about financial accounting, cash-based accounting. This is a big piece of managerial accounting that you'll be going into, all key parts that we're going to be discussing. Today, we're talking about cash flow. So 3 key activities: operating, investing, financing. And the way we reconcile between accrual-based and cash-based financial statements is through 2 methods, the indirect method and the direct method. To give you an example, the indirect method is so common that over 90% of companies only use the indirect method to reconcile their financial statements. That's what we're going to be covering today. Very few companies use the direct method. It's very difficult to do, but if you can do it, it's very useful to understand the operations of a company. So we'll go over these 2. You only need to know the indirect method and understand these 3 activities. So ultimately, why are we reporting a statement of cash flows? Remember, the whole reason we're doing accounting is for investors. If I'm an investor, I want to know how much cash is coming in the door, how much cash is coming out the door, and those reasons for the cash inflows and outflows. I also want to know net income on an accrual basis, how we're earning money, how I can compare to other companies, but cash really matters. And I'd argue for small companies, the statement of cash flows matters more to me than accrual-based financials until we get to much bigger investments. So how does a company receive its cash? Where is the company spending its money? What explains the cash and the cash balance? What explains this change? And why does income and cash flow differ? So these are questions that I would ask before I join a company, before I am employed by them, before I invest in them. Understanding the cash, at the end of the day, a company can't run without cash.